Benjamin Tal, Deputy Chief Economist at CIBC Capital Markets. Completely different, really, aren't they? Jay Powell saying, the beatings will continue. I'm going to go on raising interest rates. Tiff Macklem explaining, trying to justify his decision for standing pat. Could you start off with the Bank of Canada? Do you think Macklem and his colleagues are worried they've slowed the economy too much?
Yes, absolutely right. The tale of two banks, very, very different language. And the Bank of Canada is very serious about trying to avoid overshooting. I think they're already starting to overshoot, and they know that. Now, why is it so important and why we have this difference in language between the Bank of Canada and the Fed? One of the reasons is simply the effectiveness of monetary policy. We have to realize that the Bank of Canada is much more effective in terms of raising interest rates than the Fed as far as the household sector is concerned. We have to remember our mortgages are for 5 years. Theirs 30 years. It's therefore more sensitive. Then, of course, in the US in 2008, they went through the mother of all deleveraging. We haven't. Actually, our debt-to-income ratio went up during this crisis from 140% to 160%, which means that we are more sensitive to higher interest rates because we have more debt. So the tiny Bank of Canada is more powerful than the mighty Fed, and therefore it makes sense that the Fed will have to go higher than the Bank of Canada to get to the same place. And that's why the risk of overshooting in Canada is higher, because the Canadian economy, and especially the housing market, is more sensitive to higher interest rates. I think that's part of the story.
That's very interesting, isn't it? We should remind the viewers of that. So Canadians tend to go for the short-term mortgages, and the Bank of Canada policy influences short-term interest rates, at least in the near term.
Absolutely. And remember, in the US, it's 30 years mortgages. So the impact of higher interest rates is very, very gradual. In Canada, you reset your mortgage much, much faster. So the impact is more significant, more immediate. And I think that the governor is very well aware of this power that he has. And therefore, you want to stop before it's too late. Overshooting in Canada will be even more significant than overshooting in the US.
He can't, though, I presume, let his interest rates get too wide from the US. Otherwise, there'll be a flood into the Canadian dollar or vice versa.
Exactly. And that's one of the reasons why the Canadian dollar was under pressure over the past few months, this gap between the US and Canada. And to the extent that now the Fed is more hawkish in the language, clearly is a factor. Now, remember, we have to distinguish between what the Fed is telling us, what the Fed will be doing. The Fed has to be hawkish in the language because the last thing they want is a rally in the 10-year rate. The minute you say, okay, everything is fine, inflation is under control, we are done, guess what will happen to the 10-year rate? It will go down. That will sabotage what he has been trying to do for a while. So we have to distinguish and really understand that what he has in mind is the long end of the curve that he cannot control as opposed to the short end of the curve.
Do you think, is Tiff Macklem, what could prompt him to go back and actually raise interest rates again? Presumably a surge in inflation.
Yes, that's a tricky one, because he's telling you that it takes forever for monetary policy to actually have an impact, 18 to 24 months. We know that it's cooking. We know it's in the pipelines. We know that we haven't felt all the damage, especially in the housing market that is really, really sensitive to higher interest rates. At the same time, show me the central banker that will have the monetary guts to stop raising interest rates when inflation is accelerating. So the risk is definitely there. If for some reason service inflation is not behaving, for some reason supply chain is starting to move north again, for some reason something happened with China, the opening up and impact on commodity prices, you know the story. There is a lot of uncertainty regarding potential inflationary forces, and that's when we are going to see overshooting. And that's when we are going to see not 0% GDP growth, which is a wannabe recession. It will be a more significant old-fashioned recession. Let's hope we are not getting there.
Companies, do they still have pricing power in this market? Can they hike their prices, Benjamin?
I think this pricing power is diminishing. We talked to a lot of CEOs, and they're telling us in the past it was much easier to do, not anymore. I think that the inflationary forces coming from overpricing and basically hiding behind the inflationary fog, not there to the same extent that they used to, and that's good news, and I think that they know that. This means that companies will be facing downward pressure on their margins. It's happening already, and that's something that I think will lead to some investment to increase productivity down the road. Not going to be in 2023, but I think in 2024, 2025, we're going to see a surge in business investment.
You are a keen observer of the labour market, and you've told us in the past that with less availability of workers, companies are going to have to invest in more productivity, self-checkouts, things like that.
Absolutely. There is no choice. There is no choice. Profit was easy for the past 20, 30 years because of globalization, just-in-time inventories, and the labor market was a very giving market. Now everything is upside down. You have deglobalization, you have just-in-case inventories, and the labor market is not as giving. And clearly, all those green initiatives that are important are also expensive. You have to do something to replace labor with capital, and I think it will come over the next few years.
It's interesting, isn't it? We've let our, I'm thinking about North America, European countries, not all of them, but many, we've let our industrial base just be eroded by China and other competitors, and we're trying to rebuild it.
It will take a while. It will take a while, but we are moving in the right direction. You see a lot of onshoring happening. And what's interesting, with onshoring, you get the work back, you don't get the workers back, which means that you will have a lot of demand for workers coming down the road, another factor that will increase the bargaining power of labor that is already rising.
Benjamin, if a 17-year-old person came to you and said, what career should I choose? What career will be in demand? Is there anything that springs to mind?
You know what? It's everywhere. First of all, trades. We are really missing a lot of people in trades, so we have to break the negative stigma associated with trade. But clearly, we're talking about numbers. We're talking about anything to do with computer engineering, anything to do with computer programming, anything to do with the new economy, artificial intelligence, you will be there. But it's not just that. It's also trades. We have to break the negative stigma associated with trades. We need more of them.